Welcome to the Deep Dive, where we take the sources you share and cut straight to the core insights. Today, we are looking at Afcom Holdings Limited. They're a recently listed player in India's air cargo space, and frankly, they are incredibly ambitious.
Incredibly. I mean, the transition they're attempting is massive.
Exactly. They're shifting from a sort of flexible quasi-charter model to owning and operating a full fleet of 5 freighters.
And they want to do it all by the end of this financial year.
That kind of move just demands a closer look at the fundamentals. So our mission today is, well, it's twofold. First, we're going to unpack their financial performance from the recent half-year result.
The one's ending in September.
Right. And second, we're going to really analyze management's aggressive growth guidance. They're targeting over 1,000 crores in revenue. We need to identify the critical financial nuances and the red flags we found in their earnings transcripts and data.
Yeah, and that kind of rapid scaling really requires granular analysis. When a company moves from a small model to, fully operationalizing a 5 aircraft fleet, the risk shifts completely. It's not about market demand anymore.
It's about execution.
It is all about execution quality. For any sophisticated investor or a finance student tracking this space, understanding these levers from working capital to utilization rates is absolutely critical.
So if you find value in this evidence-based deep dive, please take a moment right now to like, share, and subscribe. And make sure you hit that bell icon so you're immediately notified when our next analysis drops. Okay, let's get into the details of the business itself. Afcom was incorporated back in 2013, listed just this August, and now they're really stepping into the spotlight. Before we talk scale, what exactly is their core service? Who are they selling to?
Well, they provide airport-to-airport air freight services, but they're very selective. They focus on the high-yield segments.
Okay, what does that mean?
Things like e-commerce, time-sensitive mobile phones, electronics, and also high-value perishables like seafood. Their whole strategy really hinges on these Boeing 737-800 pure freighters that they're dry leasing.
And they're moving from a quasi-charter model to taking direct control.
Exactly. They've been doing that since 2021, but now it's about full operational control.
This brings us right to their competitive advantage, their moat. So much of air cargo moves in the belly of passenger planes. Why does Avcom's pure freighter model give them such an edge?
Oh, it's a huge fundamental advantage. There are really 3 things the belly of a passenger jet just cannot do effectively. First is just size.
The dimensions of the door.
Right. The door dimensions are restricted, which limits the bulk or the shape of the cargo you can even load. Second, there's flexibility. Your cargo space is always subject to how much passenger baggage shows up at the last minute.
So uncertainty right up until takeoff.
Total uncertainty. But the real moneymaker for Afcom, the third point, is the type of cargo. Electronics with lithium batteries, specialized machinery, or frozen foods that need a lot of dry ice. These are all classified as dangerous goods. They're often restricted or just flat out banned from passenger flights. A pure freighter can carry this high-yield cargo reliably.
So they're offering capacity that literally doesn't exist elsewhere in the market. They're competing on access, not price.
Precisely. Which makes their move to their own fleet much more strategic.
Now, they initially chose to operate as a non-scheduled operator, an NSOP. Why not go straight to being a scheduled operator, or SOP?
That choice of NSOP in the beginning gives them immense operational agility. That's key when you're scaling this fast. I mean, they mentioned, for example, quickly adding these high-demand routes to the Middle East and the Maldives, partly because regional conflicts shifted freight traffic.
And as an SOP, that would have been a bureaucratic nightmare.
It would have taken months to get the approvals. So right now, that flexibility to deploy their network is far more valuable than the marginal cost savings an SOP might get on things like landing fees.
Right.
They plan to switch over once the fleet grows beyond 5 planes, which is pretty standard.
And to de-risk this whole expansion, they use these minimum guaranteed return contracts, MGRs. How do those work?
They're a brilliant risk mitigation tool. Afcom partners with exclusive GSSAs, that's General Sales and Service Agents, for specific regions like the TTK Group for India.
Okay.
The contract, the MGR, ensures the GSSA guarantees a minimum of either 50% revenue or a 50% load factor for every single flight for the entire contract term.
So it's basically a floor under their revenue.
It's exactly that. They know half their capacity is pre-sold before the plane even takes off, which, it insulates them from the risk of flying half empty while they're still ramping up their own sales.
That strong foundation leads us right to the numbers. Looking at the first half of the year, H1, revenue was 90.19 crores. What does the year-on-year growth look like?
The growth is Well, it's undeniable. Revenue was up 26.48% year-on-year. And if you look further down the P&L, the profit after tax, or PAT, that grew even faster.
How much faster?
It rose by 54.64% year-on-year, hit 18.86 crores for the half year.
Wow. That suggests some serious operating leverage. Let's look at EBITDA. For anyone new to this, that's earnings before interest, tax, depreciation, and amortization. It's the pure profit from just running the planes.
And the EBITDA performance is really where the story takes off. They reported 27.49 crores in EBITDA for H1.
Which is a huge jump.
A massive 65% year-on-year increase. That kind of jump really suggests they're hitting a critical scale where they're just absorbing their fixed costs much more efficiently.
65% operational profit growth is phenomenal. What about the longer-term trend for their margins?
If we use the operating profit margin as a proxy for their EBITDA margin, we see this consistent upward climb. It went from 22% back in March 2023 up to 24% by March 2024, and now it's peaked at 29% in this latest half-year period.
So they're knocking on the door of 30%. What is management guiding for the future once all 5 planes are running?
They're remarkably confident. They're projecting a conservative 30 to 34% EBITDA margin per aircraft. And that's based on maintaining just a 75% cargo load factor, or CLF.
But wait, didn't the transcript say their current flights are running much higher than that?
That's the fascinating contradiction here, yes. The transcripts reveal that current operations are already at a 95% plus CLF.
So what does that mean?
Well, it could mean one of two things. Either management is just significantly under-promising on their potential yield, or the market demand is so incredibly high right now that they're just maxing out every flight. If they can keep that high CLF on the new planes, that 34% margin guidance might end up looking very, very conservative.
We've got strong revenue and margin growth, but rapid expansion always eats up cash. How is the balance sheet holding up with this fleet scale-up?
We have to look closely at the capital expenditure. The move to dry lease involves these big one-time setup costs. Management calls them preoperative expenses. They detail that 31 crores was capitalized just for the first 2 planes. That covers everything from tools and ground equipment to training and salaries.
And how does that eventually hit the profit and loss statement?
That 31 crores gets charged back over time as depreciation. They've set the asset life at 8 years on the books with a 5-year schedule for tax purposes, and that started this September. So future earnings will bear that cost even though the cash is already out the door.
And structurally, is the balance sheet healthy? Are they drowning in debt?
Structurally, it looks pretty robust. Their reserves were substantial, over 85 crores as of March 2024. And while they had about 34 crores in debt then, the IPO proceeds helped them pay some of that down. The debt load seems manageable.
Okay, let's switch to the quality of their earnings. The sources pointed out a discrepancy that analysts flagged about their tax payments. Why is that a red flag for cash conversion?
This is a really crucial point about cash flow quality. In the last fiscal year, the tax expense on their P&L, their income statement, was 8.85 crores. But the actual cash tax they paid was much, much lower, only 3.69 crores.
So where did the other 5 crores go?
It's mostly from using deferred tax assets. Now, that's a legitimate accounting practice, but it means the high P-date number they reported isn't fully turning into cold, hard cash flow. You have to watch the cash conversion, because once those deferred tax assets are used up, their actual cash tax payments will spike, which could really pressure their net profit in the future.
That's a great point. It's about tracing the profit all the way to the cash flow statement. Speaking of cash, what's the working capital estimate to support the full 5-plane fleet?
Management thinks they'll need about 50 crores in working capital based on a 60-day cycle. They plan to fund this with bill discounting, and they project the interest on that will cost them between 4.5 to 5 crores annually.
Let's move to the ultimate test, capital efficiency. We're talking return on equity, ROE, and return on capital employed, ROC.
Correct. ROE tells you the profit for every rupee shareholders put in. ROC is broader. It's the profit generated using all capital, so owner's equity plus any debt.
And what are the current numbers telling us?
The current ratios are genuinely strong. ROCE is at 36.0% and ROE is at 28.9%. What's more compelling, I think, is the history. The 3-year average ROE is also stable at 28.6%. This shows a sustained track record, not just a one-off spike.
Okay, so we have fantastic returns on one hand, but we already flagged the working capital stress. Doesn't that get completely undermined by the soaring debtor days?
That is the core tension in this entire analysis. The efficiency ratios look great, but the collections process is creating a huge drag. Debtor days, the time it takes to get cash from customers, have increased sharply.
How sharply?
They were at a respectable 56 days in March 2024, but management is projecting they will balloon to 95.5 days by next year.
Wow, you're nearly doubling your collection time. What does a 95-day cycle practically mean for that 50 crore working capital need?
It means they need more cash for longer, just to bridge the gap between doing the work and getting paid. If your revenues surge to 1,200 crores, but it takes you 95 days to collect, you're going to need a lot more than 50 crores in working capital. This is probably the most significant operational red flag for their cash flow health. It's a real efficiency killer.
The company's whole future is built on this aggressive fleet strategy. Let's just confirm the timelines and those massive revenue targets again.
The timeline is incredibly rapid. The first two B737-800s start flying commercially this month, November 2024. The goal is to get all 5 B737s inducted before the financial year ends in March 2025.
And then phase 2.
Phase 2 in FY26 is the intent to add 2 larger, wide-body 777 freighters.
And if they hit that 5-aircraft goal, what's the revenue potential?
Management's estimate is about 18 to 20 crores of revenue per aircraft per month, and that's based on a conservative projection.
Right, the 75% load factor.
Exactly. So for a full year of operating all 5, they confidently project a tap line of, and I quote, upwards of 1,200 crores in FY26.
What's giving them this confidence? What are the external drivers?
And they point to massive external tailwinds. The whole regional air cargo market is growing at a healthy 6-7% CAGR. But crucially, they noted that the West Asian conflict has severely constrained capacity, which is hardening freight rates. They're basically trying to scale up to capture that temporary market spike.
Okay, but let's look at a major operational flag here. Management says they need all 5 planes quickly for redundancy, to avoid an aircraft on ground situation, and to manage crew duty times. But there seems to be a contradiction in their utilization plan.
Absolutely. The Boeing 737-800s can technically operate for 17 to 18 hours a day. That's their physical limit.
And what's Afcom planning?
Well, their current operational schedule starts at only 9 hours of utilization per day.
Less than half.
Less than half. And this is the critical execution risk. Why rush to commit capital for 5 planes if your initial utilization plan is so low? It suggests either their operational ramp-up crew training scheduling is lagging behind their capital spending, or they're just being overly conservative. The real challenge will be scaling from 9 hours a day to 17 or 18 to actually hit those 1,200 crore revenue targets.
This has been a deep dive into what is clearly high growth, but also high-risk territory. Let's synthesize the crucial points now, the upside potential and the critical risk factors.
Okay, on the upside, I think there are 3 compelling positives. First, strong operational momentum. The move to self-operation has yielded impressive profit growth with that 65% EBIT to jump in the first half.
Right.
Second, robust moat and guaranteed demand. Their pure freighter model gives them access to high-yield cargo that others can't carry, and that demand has a floor under it from those GSSA MGR contracts.
And the third positive?
Third is their efficiency track record.
Yeah.
They have a history of high and sustainable capital returns with a ROCE of 36% and an ROE near 29%.
Now, for the other side of the coin, what are the 3 most significant negatives or risks that you need to be watching?
First, and I think most importantly, is the working capital strain. That projected jump in debtor days from 56 to over 95 is a major red flag for their cash collection speed and could force them to borrow much more than planned.
Okay. Number 2.
Second is that financial nuance we discussed, the gap between the tax they report on the P&L and the actual cash tax they pay. It just requires a careful look at whether their reported profit truly reflects sustainable cash flow.
And the final risk.
And third is the aggressive execution and utilization risk. The whole story depends on them deploying 5 planes by March and, critically, scaling up utilization from a planned 9 hours a day to its full 17-hour potential to meet that 1,200 crore revenue projection.
So at the end of the day, Afcom's success doesn't just hinge on getting the planes. It really hinges on management's ability to transition their entire operational and sales machine from a small, flexible model to a massive 5-plane operation that can service 1,200 crores in revenue, all while getting those soaring debtor days back under control. That balance is the defining challenge for them over the next year. If this detailed fundamental analysis has added value to your understanding of the air cargo sector and Afcom Holdings, please help us reach more informed investors and students just like you. Remember to like, share, and subscribe to The Deep Dive, and please click the notification bell to ensure you never miss our next analysis.
Thank you for joining us for this deep dive. We look forward to connecting the dots in the next set of sources you share.